Welcome back to In the Harbor, the podcast where sports, leisure, and finance meet. I'm your host, Jason Johns. Today I'm joined by co-host Mackey Daniel. How you doing, Mackey?
I'm good. Still adjusting to the time change. It always takes me a couple days, but we'll be in good shape. It's more the dogs that are adjusting even more.
Well, fall back is better than spring forward, I think.
I agree. But all good, and really excited to announce our guest today. We are joined by a fellow Michigander who went from the Great Lakes to one of the largest hedge funds into the world and is now bringing hedge fund insights to every investor. Welcome to In the Harbor, Bob Elliott, co-founder and CIO of Unlimited Funds. What's happening, Bob?
Thanks so much for having me. It's exciting to swap some stories. When I talk to you and you say that you're going down to the Hunter House for lunch, it recalls childhood memories. So it's nice to talk to some folks who are from my hometown.
You know, a lot of news on Hunter House. They just moved locations. The historic building they've been in for 70 some years. They've relocated.
What? That is blowing my mind.
I guess it's the urban development of Birmingham that's pushed them out of downtown.
Yeah, they moved over to, there's a KFC right at the corner of Adams and Woodward just before Lincoln, and they're moving in there. The best news is the grill is going with. So, you still get the flavor savor of the old grill, but yeah, new stomping grounds.
That's wild. I mean, it's the building was a bit of an eyesore for modern downtown Birmingham, but it's good to hear that at least its spirit is moving just down the street. Although I'm sad that KFC always had that very famous sign with the bucket that was at least 25 years ago. It was a huge controversy about whether the bucket sign could continue or not. So
well,
there's always something in town.
That's absolutely true. But I think it was 70 some years they were there.
73.
And Friday of Halloween was their last day, and they relocated on Saturday. So it was a zero business interruption move, which is rare in today's world.
We went the week before, and it was absolute chaos. I think we got there at like 11:30 and still waited 45 minutes for food. Everyone had the exact same idea. We got to go one more time before it leaves. It's gone.
Well, I think we should let's jump into your background a little bit then. Growing up, Birmingham, Michigan, then you make the move. You go to school on the East Coast and then into finance and Wall Street. And tell us a little bit about that.
Well, I had never really expected myself to be in markets. I was, I probably got first introduced into markets seriously when I had a pile of caddy money in a shoebox and walked down the street and decided to sort of knock on a few doors and see if anyone would take my dough. Because it was always a little awkward when I used to walk into the bank with my box full of cash from caddying and deposit it each week. And I made a pretty good sum doing that. So it was I walked down the street to all the various financial brokers and things like that. There on Old Woodward, and somebody was willing to take my money. It was a good trade for him many years ago. Still my financial advisor today. And that really started my journey in terms of being interested in finance. Even in an academic setting, my academic experience was mostly in the sciences in various ways. And so I didn't really think that I was going to be like a professional trader or professionally in markets really at all until I was in college and worked on a variety of different public health related issues and things like that, and sort of increasingly recognized how macroeconomics and the macroeconomy sort of drives public health that frankly drives pretty much everything. And I thought I'd go, check out this hedge fund, get paid to basically get a master's in macroeconomics and then figure out what I was going to do with my life. And turns out, 25 years later, really fell in love with with markets and macro, and still doing it to this day, which is great.
Isn't that funny how sometimes you never know? Like some things just find you at the right place, right opportunity, and it's kind of serendipitous how it all works like that.
Yeah, I mean, for me, it's really about there's always something to learn, right? That's the beautiful thing. I can't imagine being in a place where you're just constantly just doing the same thing over and over again, even if you're very skilled at it. You know, the beauty of the markets is that they humble you every day. And so that means there's always something to learn.
Well, and the variables are always evolving and changing. So definitely a learning environment as new things happen. We'll get into that a little bit on the macro side. Let's talk a little bit about what you're doing currently when you founded Unlimited Funds, kind of what was the focus behind that?
Yeah, I was in the hedge fund business for a long time at the world's largest hedge fund, and I was there creating a lot of proprietary strategies across all sorts of different asset classes, and over time, I sort of increasingly realized that there were sort of two key realizations, key understandings that kind of everyone in the building and everyone kind of in the industry acknowledged, but wouldn't say out loud. And those two things were, one, we were no better than all of the rest of our institutional peers in the hedge fund business, even though, everyone is trying to jockey to say that they're better than everyone else. And the second, which was certainly never spoken out loud, which is we were getting paid way too much to do what we were doing. And when I realized those two things, I recognized that actually the right way to think about managing hedge fund strategies was not trying to prove that you're smarter than everybody else, but instead was trying to figure out a way to bring low-cost indexing to the world of 2 and 20. And obviously that took me down a much different path than the rest of my peers who are all hanging out, charging their 2 and 20 and making the sort of high fee income in a way that's not that much better than investors. My idea instead was to basically take my years of experience in the hedge fund business, and instead of hanging my own shingle and doing my own proprietary views on a day-to-day basis, was to basically create technology that allows me to look over the shoulder of how all these skilled asset managers and hedge fund managers are positioned in real time. And then with that understanding, basically take it, translate into long and short positions in liquid securities, which I can use to back ETFs. And because I'm using technology instead of hiring expensive people, I can do it at a much lower fee point. And because I can put it in an ETF wrapper, it's accessible to all investors. It's much more tax efficient, low cost, liquid, transparent, all the advantages that exist in the ETF world. And so it was basically a recognition that, we could bring these hedge fund strategies and make them available to all investors at a low cost.
Which is a different approach than a lot of what we're hearing in the financial media today about bringing these illiquid securities to everyday investors.
Yeah, I mean, I think the challenge with the vast majority of people trying to increase access to the everyday investor is they're mostly like bringing lots more high fee product and finding a new cohort, and even worse, finding that new cohort and building products that are delivering negative selection assets in them because they can't sufficiently diligence them. And so the thing that investors need is they need more access and lower fees. That's what they need. More access, lower fees, not more access and high fees. That just makes things worse for them. And so that really is our focus, is how do we bring, 2 and 20 strategies, starting with hedge funds and over time also working on things like venture capital and private equity, and bring it at that, 100 basis point low fee point so that every investor can get access.
Would you say it's safe to say that the two biggest driving factors behind founding Unlimited Funds is then humility and access? We only know what we know. We can only observe what we can observe, and we just want to bring that to everybody. Is that a fair assessment? Yeah,
for sure. I mean, humility. It's interesting how you can always tell folks who have been in the markets for a long time because they have humility and they can talk at length about all the things that they got wrong. And I think one of the sort of core recognitions was that my own proprietary views, those of a particular manager, are not necessarily any better over time than all the other institutional quality managers. And if that's the case, why the heck are we all jockeying for position rather than just taking the wisdom of the crowd and using that? And, it's probably not something that you'll have any other manager come on this program and say, which is, hey, in aggregate, I'm no better than all of my peers. Right? that certainly is not the sort. And then on top of it to say, and hey, I'm getting paid way too much, right? Those two things, very different than what pretty much every asset manager on the planet says. But, in a lot of ways, I like to think about in the same way that Bogle's folly 70 years ago was about bringing low cost access to stocks and bonds to everyone. That's basically what we're trying to do with 2 and 20.
Right, and we see that fee compression that permeated the kind of the retail environment from mutual funds to the advent of the 3 basis point index. And then you've even seen 2 and 20s migrating towards like a 1 and 10.
Yeah, that's right. And there's naturally, all of this fee compression is basically rationalizing how much should you pay for skill, right? And the answer is if you're buying SPY or whatever, or just index beta, there is no skill, you should pay nothing for it, right? Other than a de minimis operational expense. Now what's happening is we're going up the chain and we're saying, okay, so there's all these people who are getting paid for active management. What is that actually worth? And I think one of the things that's super interesting in the hedge fund space is 2 and 20 strategies are still the vast majority of funds still operate in a 2 and 20 framework. Maybe it's 1.5 and 15 on average or something like that, but it's still basically the same. And the challenge with that is that when you charge fees at that level, basically all, the managers make plenty of money and the investors don't share in that benefit. There's of course always the old joke around, where are the investors' yachts? Well, I've seen the hedge fund managers' yachts and they're pretty big and, out chasing the giant squid and things like that. When the everyday investor, and the investors in these funds are not seeing those benefits. And so I think that when I think about hedge fund strategies, the main thing I think about them is that there's not a strategy problem. There's a fee problem. And if we can resolve the fee problem, the strategies are actually great. Look at all the managers' yachts.
Well, I might be getting kind of offline here, but the one thing I always found interesting with some of the large, well-known hedge funds when they have decided to go and turn themselves into a single-family office, their assets under management doesn't really change.
That's right. Because over time, they're just, they're making so much money that they push out the other investors, right?
Right.
So they take all the money from the investors and their fee income, and then return capital over time so that they can run their strategies fee-free for themselves. And that's the dream for a lot of these managers.
I didn't realize how big of an issue that was, or maybe issue is not the right word, but how prevalent that was until I read the book about Jim Simons and Renaissance Technologies and how quickly they exploded, and the flagship fund, it was all employee money. And rest in peace to Jim Simons, obviously a brilliant mind in the industry, but the name of the book's escaping me. It was a fantastic read, but that was the first time I realized, whoa, I didn't realize this is going on.
Yeah, I've read the book too, and it's a great read. The name also is escaping me right now. I'm sure somebody can look it up, but it's absolutely a great read. Now it's interesting, their strategy, their flagship strategy, which was in a lot of ways a market making effort, a tactical market making effort. It's so interesting to see how their sort of their external investor based fund has struggled because it's hard. The reality is it's hard for a lot of these managers to extend their alpha. So you find a niche, or you find some area that you're generating some alpha on, and then all of a sudden you go, for instance, if we talk about the sort of big multi-managers that have gotten a lot of the press attention, they've gone from $1 billion or $500 million in assets to $75 billion in assets. And a bunch of people are sitting there looking at those managers, and they're trying, the managers are basically making the case that their track record at 500 million is the same as a track record at 75 billion. And that's total nonsense. And I saw it firsthand, a fund that went from a few $1 billion to $150 billion. Like, the scale is an issue. And so I think a lot of folks are trying to, trying to sort of repeat the hype that exists without actually recognizing that the most reliable way actually to generate alpha is basically to diversify and lower fees. Those are the two best ways, right? Not accumulate assets, but diversify your manager base and lower your fees. You do those two things, and you're going to be in good shape in the hedge fund strategy world.
When thinking about this venture with unlimited funds and the way you've had to pivot in a lot of ways in your career, it seems to me that in a lot of ways the traditional hedge fund world tries to fly under the radar. And now that since you started unlimited funds, your research is out there, a lot of appearances on TV. How has that shaped your role as you've made this transition to unlimited funds in what your day-to-day looks like? And I ask that because we want to get into some of the writings that you've put out recently after touching on this.
Yeah, well, I think for me, a big part of my research process when I was developing proprietary strategies was writing the daily note that daily research note that Bridgewater put out. It's called the Daily Observations. Actually, just celebrated its 50th anniversary. Kind of amazing to think about a publication going for 50 years. And I think, and for at least for me, what it became was it's sort of my method to internalize what's going on in markets, think about what's happening, and then has all the benefit of then, putting that out into the world and then getting feedback on it, right? People will agree. A lot of people will disagree. That's fine. And you inevitably learn from it. And so after I left the hedge fund world, and where that note was basically just for big institutional investors, I thought not only should we be working to basically make institutional quality strategies or investments available for every investor at low cost, we should also be working on how do you make institutional quality research and insight available for all investors. And that's why I started basically writing every day. Part of it was my own process, but the idea was make that process that I was going to do anyway sort of clear and visible to everyone out in the open, so that they could see how that process works. And so, I started for a while just writing on Twitter, which surprisingly worked out. It's an interesting environment where I do really think a lot of there's all sorts of crazy stuff on Twitter, but I'm saying in sort of the macro research world, there's actually a lot of great content, good people, robust discussion. And then more recently sort of transitioned that to the Substack environment, which is a little more formal in terms of writing with my non-consensus newsletter, but all sort of born out of the same thing, which is the way I've learned to process and think about markets is every day coming in, seeing what's going on in markets, and writing, basically writing through my questions or my observations or my thoughts on what's happening.
Well, and that brings up an interesting question. So when you're starting your day, what's your go-to either publication or website that you're looking at to kind of get a pulse on what's going on? Yeah.
So folks who know me well know that I'm really cheap. And so my favorite is, forget the Bloomberg terminal. Never had a Bloomberg terminal in my life. I look at Trading Economics, which is free, which is great. And it has all the macro data and all the core market data that you want to have to look at. And so I start my day basically every day looking through Trading Economics, which basically has all the market information, and looking at the intermarket action and what is that telling me about what's going on in the world, looking at the incremental macro data that's been released globally and thinking about how that influences what should be happening in the markets. And then, of course, reading sort of the standard news sources, FT, Bloomberg, et cetera. But really, Trading Economics is kind of the core of what I use. I do not get paid or sponsored in any way by Trading Economics. Just good and free, and you should use it because it's a good resource to have. And then a lot of my writing just basically is cribbing charts from it and putting those together as I'm thinking through what's happening.
So as we think about your writing too, I want to, the most recent Substack you put out, I think that was that last week?
Probably I put one out actually every single morning, but the last free one, I put out one that's free for everyone.
Well, Bob, it turns out I'm cheap also because I only look at the free one.
Because you only get the freebie.
That's right. So it was the last free one where we talk about the CapEx spending.
Yes,
in the hyperscalers.
That's right. That one,
and I think
that one got a lot of attention, a lot more attention than I was necessarily thinking it would.
Well, and then on Twitter, you had a lot of comments on both sides. Were people telling you why you're wrong, or people agreeing with you, which is fun to read through the comments.
Yeah, I think as I said, Twitter can be an odd place in certain corners of the world on certain topics. But for those, what I like to call the macro nerds who get really focused on what's going on, it's actually quite a robust environment. And so I for a little while there, I write for my subscribers, and they get my pieces live during the week each morning. And then I was thinking about, what should I make free? And for a while, it was just whatever was interesting to me. And then I said, you know what I should do? I should just, whatever gets the most attention on Twitter when I, send the blurb out in the morning and the core insight, that's what I'll do. I'll make that free. So this was a product of that process, which was that people seemed very interested either for or against. Which I guess is really any good non-consensus idea should have a lot of people that disagree and a few people that agree, right? That's kind of what you're looking for in terms of a novel insight in terms of what's going on in the markets.
Well, and I think if you go back to culture at Bridgewater, I remember a legacy story where they talk about if everyone agrees, they don't proceed, essentially, because there's obviously a blind spot. If everyone's in agreement, there's got to be a blind spot.
Well, I think actually part of the reason why I labeled this, or I named the Substack non-consensus, is because I think people often forget in the markets, in order to generate alpha, meaning in order to get differentiated performance, you have to have non-consensus ideas, meaning the consensus is already baked into the price. Whatever the price is today is all of the views of everyone coming together. And so, in a lot of markets related content, like if you watch CNBC, which people probably shouldn't be watching too much CNBC, except of course when I'm on Fridays at 4. But other than that, what you hear all these people come onto the television, and they basically just say the consensus thing. So someone will say, I think the Fed will cut one more time this year, and it's like, okay, who cares? Like that is not helpful in terms of creating differentiated insight. Everyone knows that's happening. Who cares? I mean, maybe acknowledging that the consensus is largely an accurate pricing is okay, but it's not the sort of thing that's going to create differentiated performance. To create differentiated performance, you have to have differentiated views, which means you have to be consistently looking for non-consensus ideas. And by definition, those non-consensus ideas are going to piss off a lot of people, right? Because it will challenge the consensus thought. And in this case, there's a lot of techno-optimists who are very bullish on all this investment that the hyperscalers are doing right now, and simply challenging them around what the likely ROI of those activities is, which is likely low, just based upon what we're seeing so far, and likely in the future. That's the sort of thing that can get some folks fired up in terms of what's going on.
Right. And you look at the money being spent, to your point. I mean, if we're talking one company doing $140 billion in spend on an annualized basis, what kind of increase in stock price would they have to justify that kind of spend? It'd be astronomical, and we're already at elevated valuations.
Yeah, so, I mean, I like Meta, looking at Meta, because when I talk about this, a lot of people focus on all the infrastructure that's being built to service each other. So it's like OpenAI announces that they're going to use Amazon Cloud services for $40 billion or something like that. And you think, and the Amazon folks, the Amazon investors would be like, look, we just sold $40 billion, of revenue. But the question is not, is there all this self-referential spending between the different folks around the AI universe, let's say? There's lots of self-referential spending, which I mean between each other. The question is anyone in the real world with the real economy making any money doing this? And so you look at something like OpenAI, they're like, oh, we're going to spend $40 billion with Amazon and all sorts of other things that they're doing. And they talk about $1 trillion of investment. And you're like, okay, so what's your revenue? And they're like, $10 billion a year. Okay, what's your profit? Well, we're losing, tens of billions of dollars a year. It's like, okay, well, like that is a terrible deal, right? Like that is just, I'm a macro guy. I'm not a micro guy, but like if what's happening is I'm spending $1 trillion or $100 billion or $1 trillion, I mean, $1 trillion is what they've talked about. And I'm going to lose tens of billions of dollars. Like, is that a good deal? No, that's a terrible deal. And that is, OpenAI, I think, is one of the more extreme ones in terms of lighting money on fire, and Microsoft, of course, being connected to it. But then you even see something very plain vanilla like Meta, which has seen a modest bump in its advertising revenue of maybe a few $1 billion on an annual basis, but they're spending $70 billion in AI-related capex. Those two things don't work. You can't spend $70 billion a year in AI capex on something that's depreciating on a 5-year time frame and only make a few $1 billion more. That is a terrible ROI for that business. And that's, that's just and I don't like Meta in specific because all of their revenue is real economy revenue and advertising, right? So it's not like all the self-referential stuff. And I think it's such a good example of how, is AI beneficial? Sure. Is it incrementally productive? Absolutely. Is it game changing? Probably not, at least in any time frame that we care about as investors. And is it worth all this investment? Almost certainly not when you look at the numbers.
I would imagine that's going to be a hot take from some of our listeners too, that everything is AI right now. And it conjures up some memories of, and I've brought this up in previous episodes, of kind of the dot-com era and that run up. And I'm not alone in saying this. I mean, Paul Tudor Jones was singing Prince on CNBC 2 weeks ago, party like it's 1999, which was hilarious. But do you see similarities? Is there a speculative bubble in AI? It's like the very mention of it increases valuations.
Yeah, I think of this a little bit, not to parse words, I think it more like a mania than a bubble. And the reason why I say that is typically bubbles are significantly debt financed, and that creates a real risk. And so we saw that, for instance, in the 2000 with bubble with all of the debt financed capex infrastructure that was done, which then essentially fell under its own weight. And so the interesting thing about this cycle, which differentiates it from the previous one, is that in a lot of the cases, you could look at these companies, the hyperscalers, you could say there's kind of an old co and a new co, meaning the old co are these highly profitable, strong margin, reasonably well growing businesses like, Meta's advertising businesses, Google has, search plus YouTube, which is a great business, et cetera. Amazon's got all the different Amazon businesses. And then what they're doing is they're generating a lot of cash flow and then just taking that cash flow and investing it in this huge new co-bet. And so when you look at it, like the odds that we have, the odds that Meta, Google, Amazon don't exist 20 years from now are pretty low, given the fact that their core businesses are, in reasonably good shape and continue to grow and innovate. But the question for investors is not, will Amazon exist? That's not a particularly good question to ask. The question is, are all these companies taking, hundreds of billions of dollars of cash flow and doing a smart thing with it. Because right now, when you look at the stock prices are implying that they're going to be doing something somewhere between highly effective and revolutionary in terms of the outcome, the income generation that they're going to get. But then when you look at the actual numbers of what income they're able to generate relative to the size of the investment and the depreciation schedule, it looks pretty clearly like a negative ROI.
How many quarters, years of hard published data showing this isn't working the way we want it to is it going to take before you think we're seeing that reflected in the share price of some of these hyperscalers and huge companies that are doing this?
Yeah, it's a mania. You never know how long a mania is going to last. I think that's one of the challenges, because right now we're sort of a couple years into the investment cycle. And that investment cycle is we're sort of at the peak growth rate of that investment cycle. And now people are starting to turn their attention and say, where's the beef? Where's the income? Right. And for right now, you can tell a lot of stories that it will come eventually. Right. Amazon will claim that OpenAI will give them $40 billion in the future. And as an investor, you can kind of, you can believe that if you want. The question is, when do you get the point of, when does the point of, disappointment start to emerge? My guess is it's going to take a few quarters, but if we're not seeing, relatively significant revenue accumulation coming from these businesses, their stock prices are going to get penalized for it relative to what's currently priced in. So, it's one of these things I think about, having been in this business for a couple of decades and having studied a lot of these things. When you see manias like this, like, you basically, as an investor, have a choice. You have a choice to basically do one of two things, which is you can either be thankful that you were lucky enough to be invested and take profits, or you can lever in and try and, ride it all the way to the top, and then it eventually turns. And part of the process of, or you can go short, which can be very painful, right? That can be very painful. So I don't really actually recommend that much. But part of the process of looking at these sort of fundamentals and looking at questions like this is not to say, should you have a big short on these companies? Because whatever, it's not the thing. There's all sorts of reasons why you don't want to sit there short in the middle of a mania. But it's to say, should you count yourself lucky with what you're getting right now, or should you count yourself skilled with what you're getting? And if it's lucky, what you should do is you should be thankful and take the profits and and rebalance back that capital into a diversified portfolio of other assets that you hold. And if it's skill, you should lean in. And so right now, it really looks like the first of those, which is that investors would be much better off over the long term to take profits, rebalance back, increase their diversification, whether it's within the stock market or across assets, than it is to lean into this stuff.
Well, and in that sense, too, I would say investors, by and large, are less diversified than they've been in years. If we look at the narrow leadership of the market, the concentration of tech exposure because of these hyperscaler names we're talking about, I think NVIDIA was just about to cross $5 trillion in market cap, if it hasn't already. And that's just a crazy statistic when you think the first $1 trillion company in the stock market was only 2018. So that was 7 years ago. And now we're talking about $5 trillion companies.
Right. And now basically everyone has a huge bet on AI, whether you like it or not, right? You're in your 401k, you're basically entirely betting your 401k on whether, the ROI of all this AI CapEx is going to make any sense, which, there's a wide range of possible outcomes, of course. But if the market, and this really goes to just thinking about creating non-consensus ideas in general, the market is basically pricing in certainty that this is going to be, a totally quite quick, totally transformative technology the range of plausible outcomes are sure that could be the outcome, or the skew is to disappoint relative to that expectation.
Well,
And
I was going to say, I think that was a Bill Gates quote from a while ago, that people tend to, and I may get it wrong, but people tend to overestimate the rate of change in the short term and underestimate the rate of change in the long term.
yeah, and probably, if you look at something like personal computing, which folks may argue was more transformative or less transformative than AI, it took 25 years for it to go from being a novelty that folks dabbled in to being to generating significant productivity enhancements in the economy. And there it generated a lot of different ranges, but it probably added at its peak about 1 to 1.5% in terms of productivity growth in the economy, which over compounded over years is a big deal in terms of economic conditions. But if you were thinking in any one quarter or over a couple of quarters, like, it would not be noticeable. And so, look, you could have a circumstance where maybe this runs, in half as much time as personal computing in terms of adoption, things like that. Though there are some indications that businesses are starting to turn away from adoption, which is a concerning element, should be a concerning element, based upon the census biweekly questioning about AI usage. But even if it's like double the rate of adoption, even if it's 4 times the rate of adoption, you're still likely not getting anywhere near the real economy effect that's being priced in both into the hyperscalers, but also into a lot of real economy companies that are expected to expand their margins radically as a result of this technology.
I think it was the Journal a few weeks ago had an article about some of the major consumer discretionary names that are trying to take advantage of it. You can go on ChatGPT and order through Walmart, and even the amount of spending that they're getting from that isn't really taking form yet. And I thought when you needed toilet paper from Amazon and 2 hours later it's at your house, that was the peak of rapid fire shopping. But now you can have ChatGPT do it. But that's still not being monetized, I think, is another good example of this not being realized yet in the real economy.
Yeah, and probably over time, it will, in the same way we used to all go to the supermarket every week and go to Walmart or the equivalent every week to collect our goods. Now a lot of the stuff gets delivered, and that's we have some benefit from that in terms of in terms of efficiency. Though, what I would emphasize as an example on that is a lot of the benefit that exists even in that Amazon toilet paper case, a lot of the benefit is actually in consumer surplus. And that's one of the key things that I think a lot of the techno-optimist set doesn't quite appreciate. A lot of folks will say, hey, look, ChatGPT, let me learn about, actually, this was a subscriber to my Substack recently, was talking about, hey, I got to spend a lot of time learning about how the DH got adopted in the American League from ChatGPT in a way that I would never have been able to do before. And that's great. I'm sure, coming from an American League city, it's kind of it's natural. I don't understand why you'd have a pitcher strike out 4 times a game and think that that's good for the game. But this guy got to learn a little bit about it. He came from a National League city. And what the real question is, okay, but what income was driven by that? Like, what GDP activity was driven by that? He's smarter. He feels more educated. He gets some satisfaction out of it. Useless to GDP. His satisfaction is useless to GDP. The thing that drives GDP is income. And so the question is not, is it useful? Can I do things with it on technology? It is, does it make money? And that's the question that has not been meaningfully resolved. And so a lot of people will focus on all the sort of ancillary benefits, what I call the consumer surplus benefits, the same way getting your Amazon package, your toilet paper, so that you can, sit on the couch and watch the game is a consumer surplus to you, but you are consuming the same amount of toilet paper as you always have. right? Just think about that. You are consuming, that has not changed. Your consumer surplus has changed, but your toilet paper consumption has not markedly changed.
Right. The effort required to get it has changed. Right?
Has
it's
changed.
Easier, and that's the same with ChatGPT. I think it can make you, to some extent, better informed more quickly. Or if you can, posit some ideas and run it through ChatGPT to see kind of where the benefit is. So there are some efficiencies there, I'd say, but I can't say how to monetize it just yet.
That's what everyone's looking at. Yeah, how do you monetize it? How do you get something? How does it actually make money for you? Because the money that, one of the ways this could work is it could be like Netflix, right? Like in the sense of, you could be a consumer of it and pay a subscription fee, and that could be a way it works. But right now, I mean, what's the total revenue of all of these models? It's like, $10 billion a year. Even if it became Netflix, where essentially everyone has some sort of subscription, and it would be across different models and things like that. How big would that be? It would be a Netflix sized business would be, a reasonably sized business, but it certainly wouldn't be economically transformative.
Right. And it is my co-manager of my fantasy team right now, but I am sitting in third, so I can't say it's gonna win us the cash at the end of the year.
Again, no economic benefit there.
Correct.
Well, pivoting a little bit, I think this has sort of led us to, the effects on Main Street and mom and pop and everyday people. You had another piece that you put out recently, Bob, which was where to turn when stocks and bonds move together. If you'd be willing to dive into that a little bit, share your thoughts, and when we do have situations like this, where do people look? That'd be great.
Yeah, I think one of the challenges, if you've sort of lived through a few cycles, and I think a lot of folks kind of forget how investment cycles work, is as you sort of get to late cycle environments, how do you navigate late cycle environments? Because actually what we're seeing right now in terms of various manias, whether it be gold or AI stocks or things like that, that is a very late cycle environment. What I mean by late cycles, the economy has expanded post-COVID, particularly, but really, other than the COVID hiccup, has really been expanding for almost 15 years since the financial crisis, and we've had some tightening by the central bank. The economy is starting to slow. We're starting to see that in a lot of indicators in terms of the real economy. And in these moments, you sort of get a divergence between expectations in all sorts of different ways still remain high, while the real economy, Main Street, as you describe it, is starting to slow. And is slowing. And I think basically everyone who is connected to Main Street has seen the effects of the real economy being softer in the last year or two than it was in the bounce out of COVID. And so when you have those sorts of environments, the challenge from an asset manager's perspective is, how do you navigate it? Like, you either have to be a person who can call tops and bottoms and trends yourself, meaning follow the stock market until the point in which there's a reversal, and then follow that in the other direction, which is hard. Take it from someone who is a professional asset manager for many years, and you're competing in like one of the hardest games in the world. Or what you do in terms of your portfolio, start to add essentially tactical strategies that allow you to basically be able to go long and short assets depending on what's going on. And so that's really when I look at how, most investors, they're essentially 60-40 in some way, shape, or form. Maybe they have some what I'd call alternative assets, so things like private equity and private credit. Those are just long-only assets packaged in a slightly different way. And so the real question is, when you're thinking about how do you get diversification in these times, particularly times when you might have like a meaningful shift in economic conditions or the markets, it's really about finding strategies that can go long and short, right? The short part being very important. And and that's where these sorts of, I mean, hedge fund style strategies, managed futures, things like that can do that very well. I think it's easy to sort of, for instance, global macro strategies, global macro hedge funds, their two best quarters basically, or periods, were 2022 when all assets were going down, and this most recent period when assets were going up. Why? Because they can be tactical on both sides. And that's what investors don't have enough of in their portfolios, the ability to be tactical on up markets and down markets.
Well, and I think there's a lot of things you can do from a diversification standpoint within long-only assets also. And if bond correlations are moving in correlation with equities, the one thing we've been talking a lot about is specifically different equity factors that perform and generate excess return, late cycle in particular. And I mean, Schiller PE just hit 40 for the second time ever. The previous was 1999 when it was over 40. So I think that should make me want to pivot out of growth, but
well, certainly certainly what's happening right now is everyone's overweight growth, right? Everyone's overweight growth and underweight bonds. That's what's happening in the world, right? And so when you think about that mix, that's not a particularly great mix. That's a good mix in one particular environment, which is the mania continues, right? Then you'll outperform your peers, and everyone will be able to rub it in everyone's face over the Thanksgiving table. But that may not be how the world plays out, and it's not probabilistically how the world will play out over the course of the next 18 to 24 months, right? The range of outcomes include a big chunk of plausible outcomes that are that would favor bonds or favor value or favor, international, or all those different pieces that have so long been out of favor. And so, it really is the sort of prudent thing to do the most prudent thing that investors can do today is to be thankful for having benefited from all of this AI excess and Mag 7 excess, and book it. Take the win and take your profits and diversify into other strategies that can do well in a wide variety of different environments.
I guess building on that, what are some of the catalysts that you're seeing or hearing about from investors that are looking to diversify with things like global macro, managed futures, long shorts? What is it psychologically that's triggering hey, we haven't been in this type of asset class, this type of strategy recently. We're comfortable being there now.
Well, I think most of the folks that we talk to in the advisor community, a lot of folks that we talk to are sort of getting that. They sort of get that feeling in their gut that they're like, this has run a long way, and maybe it's time to take a little risk off the table. And when they're doing that, I think one of the interesting things is typically what you do, like if you went back 10 years ago, if you had that feeling, you buy bonds, right? But basically all these advisors and all investors look at bonds and they basically say, that has been a rough road for the last 10 years, right? We've had a lost decade in bonds. And there are varying reasons why you might think that bonds, in a strategic perspective, may not have a great return. And so when they're thinking about that, they're saying, okay, so then what else do? I go to gold. I mean, gold was a great buy $2,000 ago, and has had its own mania that's now reversing. So that's maybe not the right place to go. And so then you sort of go down the checklist. You say, bonds not sure about, gold I'm not sure about. Okay, well, what can I do? What can I add to the portfolio that can help protect me if we start to shift in a more cautious direction? And that's where these directional strategies, managed futures, global macro, have garnered a lot of attention from advisors who are sort of looking for diversification away from things like bonds and gold that just don't look like they're going to provide what they need in the event of a weaker equity environment.
I think there's still a lot of shell shock from what bond portfolios did in 2022 as well. For as bad as it was, essentially a one-off year over the last, call it 20 years. But it's sticky psychologically for a lot of investors and a lot of advisors right now.
Yeah, that's for sure. I find when I talk to advisors, they often will say, I'm shell shocked from holding bonds. I think that's a good way to describe it. But they sort of know that bonds in a negative growth environment, a weaker growth environment than expectations, are generally a good asset to be holding. And so one of the things I like to talk with them about a lot is how strategies like global macro or managed futures are actually good opportunities to rent the bonds, meaning like you don't have to hold bonds forever, right? But if economic conditions start to weaken, you do want those in your portfolio. So rather than make a strategic allocation, essentially create the opportunity to make a tactical allocation. And so, for instance, this is a good example from macro funds. When yields went up above 5% on the long end, macro funds came in and were a big buyer of yield of bonds at that point. And it's been a great return, right? It's been a great trade. Why? Because it was a very non-consensus trade. They saw weakening in economic conditions, things like the job market, labor market starting to soften. The Fed would need to ease more. So they were a good example of how you could make money on bonds, but not have to have a strategic allocation to bonds. And now that's sort of easing a little bit because bonds have rallied a fair amount. It's been a good trade. They're taking a little risk off the table. But that's kind of how you want to get access to bonds these days, given the sort of structural concerns that I think a lot of people have.
It seems like this year there's been some divergence and a little bit lower correlations in returns within different bond sectors too. You look at some of the EM fixed income that's out there, and they've crushed it this year. You're north of 10% returns in some of those sectors. It's super interesting to see that because I think for the longest time the sentiment was just we'll get our 2%, 3%, especially when rates were near zero pre-hike cycle. But it has been a good tactical opportunity this year for sure.
I think you're the only person that I've talked to, certainly in the podcast circle, who's talking about EM bonds, which is cool. It's actually the biggest. It has been the biggest area in the bond market where macro managers have been long. Is in that segment and still looks attractive from their positioning right now. So I think there's a lot to be said. There's a lot of those markets where either whether you're looking at the dollar side, where their credit risk is actually quite low from a strategic perspective across a wide variety of those economies, or you're looking at the local currency side, where a lot of those economies took very forceful action to contain inflationary pressures in the post-COVID environment. Given their long histories, and where you have double-digit yields, for instance, in some of these economies, you have double-digit yields on bonds, currencies that are low relative to history, and economies that could use some easing. That's actually quite a good combination of things for holding those local currency bonds as well.
Well, I think, too, as we see this deglobalization play out and a lot of these one-on-one trade agreements that aren't necessarily tied to the U.S. like they have been historically, and the U.S. dollar-denominated debt in these countries, as we see this play out, I don't necessarily see this going away anytime soon. Maybe it's a short to intermediate term type play out, but I think that's going to be a huge factor with that moving forward, too. And I could be totally wrong, but who knows?
Well, I think the key thing is these economies. We've been in a lot of ways in the emerging world in a 15-year malaise that basically peaked even before the global financial crisis in some cases, and then was further degraded by the challenges in the commodity sphere in the mid 2010 cycle. And so the best thing to buy is something, the best countries, the best assets to buy are where there have been big adjustments, where they're priced cheaply, there's been big adjustments, and where there's catalysts for strength. And so if you look at sort of what's going on right now, there's actually a lot of opportunity amongst a lot of these producers where China was a big sucking sound in terms of capital for 25 years, and where, from a strategic perspective, we're moving away from our connections with China in one form or another. And that is going to benefit a lot of, the friend-shoring, near-shoring, et cetera, geographies. And so you've got these economies that have went through so much pain, engaged in so much adjustment, are relatively cheap and competitive, and are growing pretty well, now poised to get the benefit from a lot of this U.S. and Western capital to come in. And so that's where, for the first time in a long time, those economies and those markets look quite interesting relative to, the mania that's going on in the developed world and the U.S. in particular.
All right. Well, I think that was a great conversation, but I know we're taking up too much of your time, Bob. So I want to keep us on task. One thing we like to do is a bit of a rapid fire questions series at the end. So, I think we'll kick it off with a few questions. You can answer them as quickly or as concisely as possible. We don't have to get too verbose.
All right.
Favorite investing principle you still live by?
You always got to be non-consensus in your thoughts.
Most surprising lesson from your time at Bridgewater?
What my most surprising lesson? That you can really use a couple of core systematic decision rules and be able to trade the world's largest liquid markets.
All right, next question is near and dear to my heart, but go-to pizza topping at Conti's.
Ooh. Now, I think the mushroom and pepperoni pizza is the lights out best pizza that they produce, because they have fresh, real mushrooms, and then those cuppy pepperonis. You put those two things together, and that is a 10 out of 10 pizza. There's no question about it.
Well, and I think the secret there is they hand cut the pepperonis, so they get the right level of thickness, and it's the smaller. I mean, it's just, I'm going to be there. I'm going there in January, so that's high on my list.
Oh yeah, it is. That's what Dave Portney pizza top 10, and for good reason. It is a truly outstanding joint. We go there every Friday night.
That's awesome.
Well, you'll have to tell Angela and Maria I said hello next time you're stopping in.
Yeah, that's right.
Michigan sports teams you still root for?
Well, still a Tigers fan. I've always been a Tigers fan because I played baseball pretty seriously as a kid, as well as the Michigan Wolverines of all sorts. Since my parents were alums, and they bred the maize and blue in me.
I think this is a good one. What's your go-to way to unwind outside of your normal work? Taking a break from the macro. What does Bob's free time look like?
Truly awful reality television.
Well, what are we talking about here? Are we like Real Housewives or Below Deck? Like, where are we going with this?
I have an encyclopedic knowledge of the Housewives. I love a good, Love is Blind. And, when I'm really feeling like I've expended all my mental energy, you get something like Too Hot to Handle to really just round out your.
I did not see that coming. So
The Keith Yandel, who played in the NHL for a long time, he's the same way. I think 16 and pregnant was his go-to. Loves all of that though.
I have to say the sleeper in that whole genre is the new series of Jersey Shore, not the old when they were on the shore, but now that they're adults and living their lives, which is called Jersey Shore Family Reunion, is remarkably good. I mean, it could be just like, it's nice to see people dealing with real world challenges, but they're funny. They're it's great. It's great. So I highly recommend Jersey Shore Family Reunion.
no, that's relatively the same cast, right? They're just old with children now.
Yeah, but they still have all the same craziness and it's fun. It's definitely, it sounds, I can understand why you'd be skeptical about it, but flip it on. I promise you won't be disappointed.
All right, that's going to make Carrie really happy when we're watching TV tonight, and I throw on some Jersey Shore reunion. I'm sure she'll be into it. Well, Bob, we really appreciate your time and having the conversation with us. It was great to hear some of your thoughts on the macro world, and of course, hear about unlimited ETFs and what you're doing there. I think it's awesome, and we wish you all the success.
Yeah, I want to give
Thanks
you
so much for having me.
one last thing. Want to make sure that all of our listeners know where to find your stuff. So let them know where Twitter, Substack, where can they find everything Bob Elliott and Unlimited Funds?
Yep. So you can find my macro commentary under the Bobby Unlimited handle on Twitter and LinkedIn and Substack and YouTube and all the various places, including TikTok for your Gen Z listeners, where I record videos while I'm walking my dog every morning about what I'm thinking about in the macro environment. And then you can learn more about Unlimited at unlimitedfunds.com.
And I think that's an important distinction on the Twitter or X handle is it's Bob E as in Elliott Unlimited.
That's right.
As
Bob
opposed to
E as in Elliott.
Yeah, as opposed to Bobby. Bobby, that
That's
could
right.
confuse people. We'll post them on the episode description as well. Thank you again very much for joining us. And you can stay on the line here, Bob, and I'll just wrap it up with that's it for the episode of In the Harbor. Thank you for joining us. Be sure to tune in wherever you listen to your podcasts. Like, follow, subscribe across all of the socials. In the Harbor Pod.